Welcome to Talking Wealth, our show exclusively for financial advisors. On today's show, we are talking to Cullen Roche. Cullen is the founder and CIO of Discipline Funds. We're going to talk about how Cullen turned his blog into a wealth management shop, why he turned his client portfolios into ETFs, and the process that goes into starting an ETF on your own. But first, a quick word from our sponsor. Today's program is sponsored by RBC Clearing and Custody. As a successful financial professional, you may be seeking independence and autonomy by starting your own registered investment advisor business. And if you've already transitioned operations to an RIA service model, you may be looking for a boutique custodian for clients who have sophisticated wealth management goals. Either way, RBC Clearing and Custody offers the resources, expertise, and solutions to help you accomplish your unique business objectives. With the support of an RIA custodian offering the full scope of the products, services, and technologies you want, you can focus on your most important asset, your clients. Visit www.rbcclearingandcustody.com today. That's rbcclearingcustody.com. Cullen, welcome to the show, man. How's it going?
Hey, Ben. How's it going?
All right, so I don't think I've ever heard the story about how you first came to create your wealth management firm. I started reading Pragmatic Capitalism probably a couple of years after, just after the financial crisis, probably 2009, 2010. And I think the reason I liked it is because you were talking people off the cliff about how the Fed's going to start hyperinflation and things are going to go crazy and the dollar's going to collapse. And so I've been reading you since then. Did the blog come first or did your own independent firm come first? How did that happen?
So I started my career at Merrill, and this is back in the right after the NASDAQ bust. And I had studied economics before that, kind of traded my way through the NASDAQ bust. And then I moved to Merrill, and that, especially 20 years ago, wasn't in love with that business model. High fees. We were basically just slinging stocks and bonds for commission. And I actually spun off and started my own RIA doing something similar, but basically cutting the fees in half. So I'm running this strategy for 5 years, basically, kind of antithetical to what I preach now, trading stocks. I'm actually doing overnight trading, kind of hilariously, just fell into the overnight effect, basically what was happening. So the strategy back then was especially effective.
So your life must have just been amazing, your social life.
Well, I'll tell you, all I was doing, I wasn't really working that much during the day because the trading hours was basically me working overnight. So I'm almost doing like the opposite of what, most market practitioners do. I didn't really care what happened to the stock market during the day. But at this time, I'm living at the beach. I'm a poor, 25-year-old guy, and we're doing 20% a year in returns for 5 years. And which for me, even with a small amount of money, I was like, this is the best thing ever. I can buy $1 beers for the rest of eternity this way. And then the financial crisis hits and the strategy completely stops working. I make no money for 12 months. And it kind of dawns on me that, hey, this isn't a good way to run a business. I need to figure out something different. And I started writing the blog in the middle of this. And I was writing about, it was mostly a personal journal. This is Pragmatic Capitalism for people who don't know. And I'm writing about really high level sort of macro and a lot of the policies that the Fed's implementing and trying to explain them. I'm not really trying to necessarily have opinions about what all this stuff is, but just writing more from an operational perspective.
Honestly, it seemed like no one really knew that much about the Fed before because the Fed wasn't as open book back in the day, right? People knew Greenspan and it was kind of like, oh, we trust this person to do something. And people are looking at the size of his briefcase to see if they cut or not. It does seem like that really shifted coming out of the 2008 crisis. Like, oh, the Fed is way more important than we thought because of what we just lived through.
And it was weird, too, because a lot of what they were doing had never been done in the United States, like especially things like quantitative easing. And for whatever reason, I was articulate about writing about this. I was actually lucky. I had a client who actually worked at Nomura, and he was on the equivalent of like what their New York Fed trading desk is. So he was a counterparty to the Bank of Japan, basically. And he was just blasting me with notes about all this stuff because he was reading my website at this time. He was one of the probably 100 people that read it. And this is in the very, very early days. And he's explaining to me that, hey, we've been doing this with the Bank of Japan for 20 years. None of this stuff works the way you guys think it does. And he's walking me through the accounting and the macro balance sheet impacts. And I'm kind of relaying a lot of this and explaining it and saying, hey, this is not going to cause hyperinflation. This is not going to cause half of the things that people think it's going to do. And this is why. And so I'm articulating this, and, luckily a lot of it turned out to be more right than wrong. And so it resonated with people because the other thing back then was that a lot of people weren't explaining. This was still somewhat, I mean, 2008 weirdly was like still somewhat early days in the internet, even because
Oh yeah.
there were
Right. There
there
was
were
no
not
Substacks
even,
back then. Social media wasn't a thing. So
yeah,
you're slowly but surely growing an audience. Did you have people say, "Hey, I'd like you to manage my money for me"? Was that when did that happen?
it was wild. The an article I wrote about QE explaining what would happen with interest rates. I wrote this article saying that long-term interest rates were likely to go down because of quantitative easing. And this was like the exact opposite of what everybody was saying. And I wrote it from like an accounting perspective. I actually outlined all the accounting in it. Bloomberg links to the article. My website goes from basically those 100 family readers to a million overnight. I mean, it was insane. And over 6 months, it grows to like 2 million readers a month. I'm actually at one point making like $250,000 in ad revenue
All right.
from the
Yeah,
blog.
back when the Gmail ads or whatever, I remember, or the
Yeah,
Google ads. Yeah, I remember that.
not much Google ad early on because I was clicking on my own ads.
Yeah,
Like,
right. uh,
uh, and so anyway, signed an ad agreement with a big investing firm that they were for whatever reason they thought that this was a good place to do advertising. But yeah, so that kind of ignited everything. And I, I mean, I always knew that I remember back in Merrill, I was always telling my bosses, like, we got to leverage the internet. This is the future. Like, what are we doing here? Knocking on doors. And I had the white pages in front of me every day at
right.
Merrill. Like, that's what it was like back then. So, you know, it's not surprising to me that blogs and the internet and you guys have obviously mastered this,
But that wasn't like your intent, right? Because when I started writing, when Josh started writing Barry, we didn't have this grand plan like, oh, we're gonna use this to get clients. It happened more organically. I think people have the plan now, but
yeah.
it sounds like you weren't writing because you thought you were gonna get clients. You were kind of trying to explain the world and understand it.
Yeah, and a lot of it was me trying to explain it for myself, honestly. I had very little confidence that what I was saying about quantitative easing was going to end up being right. I mean, it seemed from the accounting and from the history of Japan, it seemed like, okay, there's a high probability this stuff is going to play out the same way it did in Japan. But no, I was writing more from, and this is the thing that about the internet back then is that in 2008, if you Googled, the question like, what is money? You didn't get a good answer. And I was like, how come nobody's written about this stuff? So I started writing about all of that stuff. What is money? What are banks? How do these things work? And in my own client work, especially with banks, I started realizing that my retail clients, I developed a lot of relationships with banks during this time because mostly bond traders were reaching out to me basically saying like, hey, explain to me why you have this view about QE because we're trading bonds every day, obviously, and we can't get this wrong. And banks are unusual because banks have this very specific asset liability mismatch where banks are typically they're borrowing short and they're lending long, and they've got this big in between where if they don't manage their asset liability mismatch well, they end up like Silicon Valley Bank basically. And so they have to be very time aware. And I slowly the course of the last 10 years has really been an adventure in me trying to apply this sort of time-based methodology to retail investors because I've retail investors have the exact same problem. And it really lopped me over the head during COVID when my first daughter was born 1 month before COVID hit. And so the market crashes and I'm not sleeping and I'm starting to think about my whole life and my financial plan in a completely different way because what kids do to you is kids force you to realize that your life isn't about you. Your life is
Right.
now about somebody else completely. And so my time horizon for my portfolio went from being this very long-term thing, very aggressive, to being multi-generational. And I had to think about what is daycare going to cost in 5 years?
They
What
don't
is
prepare you for that one, do they? Because that's like paying for college without having 18 years to save.
yeah, well, and it's totally worth it. Like when I drop my kids off at daycare now or school even, I'm like, take all of my money, take my children
Yeah.
for 8 hours, I don't care what it costs. But yeah, it's funny though, like when you go through this like really like mind trip when you have kids where you have to start thinking about different time horizons
So
where
wait, so how did you go from trading stocks overnight to then developing a more, traditional way of looking at things where you're measuring goals and risk profiles and time horizons. Like, how did that transition happen for you where you changed your strategy?
Well, it was funny because the big part was the strategy stopped working. So,
Right.
when a strategy goes 12 months without working, and granted, like almost nothing worked during the financial crisis. Like
Right.
I remember very acutely in like August of 2007, I started to notice the strategy was not working the same. The stocks just weren't responding the same way that they typically had. And I was like, something is off here. And then obviously by like October, it was like the wheels were falling off. And then by February of 2009, it was like, oh my God, the whole world is ending. This is the most horrifying thing ever. So I I had a bunch of clients though that I had one particular client who he had a 60-40 portfolio during the GFC and it fell like 30% and it really messed him up because he had just retired and I'm navigating him through this and trying to really mesh like the behavioral finance of it and the indexing aspect because I was like this is still you have so many other assets like your 60-40 here in your 401k isn't that consequential like you really should probably just yeah, sure, it's down, it's uncomfortable. You probably should just ride it out. And that felt like such a terrible answer. I knew it was a terrible answer. Even though it ended up being the right answer, it
Right.
just felt inadequate to me. And so I started thinking about these time horizons because I was like, this guy's got a lot of different things going. And this is the problem that retirees especially go through is they wake up at retirement day and they realize oh God, I've got this big pool of money and I've been prepared, but I'm not prepared now for the multi-temporal aspect of what I'm
Right. No
about to
more
go
income
through.
coming in. I can't save. I can wait out bear markets, but I'm not putting money in as they're falling like a young person. So yeah, it's a total different freak out at that stage.
Yeah, and it's really hard on people. And so a lot of what I've tried to do is mesh the way that banks think of this stuff with the way that a retail investor experiences it, where they're as they're going through this thought process of all these different time horizons, they have to match assets to liabilities. They have to think in like a bucketing strategy, basically. But the the thing I've never liked about bucketing strategies was they always just seem kind of lazy to me, or a little bit I don't know, unquantified. Like it's typically the original bucketing strategies are typically like two or three, and it's like stocks for the long run, and then like a cash and an intermediate. It's like okay, that's good. I mean, that's probably a sufficient model, but can you refine this? Could you dig into this in a way where you're building a much more structured portfolio that looks a lot more like a pension fund or the way a bank manages because the bank has to be very very precise where they have we've got hey guys we've got $1 billion of potential deposit outflows tomorrow we have to have liquidity for that and retail investors especially retirees who are withdrawing their portfolios they have the same exact problem they have to think in time horizons and so I've gone through this really like weird battle with asset management where I've always been more portfolio manager, but I've never found the like factor investing strategies and things like that to be sufficient because I don't think retail investors think like that. They don't care about styles and quality and growth versus momentum. They don't relate to that. What they relate to is can I retire at this time with this amount of money? Can I remodel my bathroom next year?
Right.
It's
Can I
going to
meet my
cost
spending
50.
needs? Can I take the kids on a
Yeah.
trip? Yeah, you're right. It's can I reach my and for I guess the way you're thinking about it, and correct me if I'm wrong, it's like a stream of goals, right? Because every year you're going to pay for vacations, and then in 5 years you're going to have to pay for
Yep.
college, and in 10 years it's going to have to be for the wedding or whatever it is. And so you're looking at those different time horizons and goals and trying to match the portfolio to them. Like when are you going to need the cash to spend it? That's the biggest
Bing,
thing.
bingo. And that's the even if you're applying some sort of factor, like I would argue that like especially in today's world, like value stocks are I would call shorter defined duration types of equities. They're less likely to have a really high volatile sequence of returns risk over time. Whereas like something like if you're buying an AI ETF, that thing sure, it may generate really high returns, but the potential for that thing to have really high sequence of returns risk is also much, much higher than buying, boring growth stocks. And especially when you get into like fixed income, you get into tips ladders or T-bill ladders or things like that, you can start to really rigorously quantify and map this stuff out where, especially in the 0 to 5 year time horizons, you can give somebody like near precise asset allocation in terms of their asset liability match, where the buckets on the short term are they're so clear to the client that it's been fun actually working through this process with real people in the last couple of years, because it's almost like they go through like an aha moment seeing it, where you say, okay, we hold 10% of our portfolio in cash because that's going to cover you for 2 years of emergency needs.
Right.
And
That
that
that's how I
they
that's
don't.
how I always try to frame it is like, let's say it is the 60/40, and whatever the 40 safe part is, does that cover you for 10 years, call it? And then you're like, the light bulb always goes on and they go, oh, so that way I can leave the 60 alone and not
Yep.
worry about it as much. You're right. Framing it in terms of that, it seems so simple, but it's an important distinction. So you are creating, I guess, are you doing SMAs or ETF models at that point when you're first building these ideas?
Well, I built the business as an SMA business. And it was funny because we started our first ETF back in 2021, right at the peak of
So
everything
wait, so
back
back up
then.
a sec. Why did you decide to go from SMAs to ETFs? What was the thing that made you go, "Oh, this makes total sense. Why would I not do this?" Like, what's the reason you did that?
The main reason was that I was running into the behavioral mismatch of stocks growing too much, basically. So for, the last 10 years, stocks had been beating the pants off of bonds. Bonds are yielding 0% this whole time, basically, or 1 to 2%.
Right. Everyone's
And
going, "Why am I owning bonds at all?" Right?
exactly. And what's happening in every portfolio is, every 60/40 that we build, you work through a plan with somebody and you're like, okay, you need to own these 10 ETFs. They should be roughly 60/40. And by 2015, after 5 years of stocks beating the pants off of the bonds, the portfolio is 70/30. And then you're having a conversation with the client where it's like, do you want to pay taxes or do you want this new risk profile? Because this risk profile is now inconsistent with your actual
So
behavioral
you were
profile.
looking for a way to more, in a tax efficient manner, rebalance the portfolios without having
Yeah.
to, because people are going, "Why am I selling stocks? Because I'm getting out of stocks and I'm paying taxes here."
Yep. And so this is the secret sauce of ETFs, and it's why ETFs are vastly superior to things like mutual funds. Is because ETFs rebalance in kind. They can rebalance. This is especially powerful inside of a multi-asset ETF, where what I did was I took basically like 25% of our SMA business and I jammed it down into one ETF, and where like we were able to take basically the 6 ETFs that I would traditionally use and then transfer them inside of the ETF. And now they rebalance inside of the ETF. So what happens now inside of the portfolios is the portfolios, because we can rebalance inside the ETF and not pay taxes because of the in-kind mechanism, we're able to maintain a better or more consistent risk profile inside of client portfolios because of that. And it also just having an ETF, I would argue, it streamlines the asset management process. And so we're starting more ETFs on November 13th. We're launching two more what I call defined duration ETFs is what the three funds will be. And they're specifically time weighted. So they're matched to specific time horizons. And I'm doing that in large part because I'm solving a problem for myself. I mean, I would love if the rest of the world uses these funds
So
too, but like,
let's get into some of the nitty gritty here because we have advisors listening. I know there's a lot of advisors who did this. So you did this through West Crane Alpha Architect, right? They have the
yep.
business where they take SMAs, they transfer them into ETFs. And I'm sure there's plenty of advisors out there who have models like you and kind of run into the same thing. So I guess I'm sure it does make a lot of your life easier once you get through the whole process of setting it up. But what does the process of setting it up look like? How operationally challenging is it? Is it expensive to start an ETF? Like, walk me through all of that detail because I think that's the stuff that probably has some people apprehensive of going, man, that sounds like a
Yeah.
really heavy lift. I'm taking these client portfolios, I'm having to have the clients transfer in. It sounds kind of scary, even if after you're done, it may be easier. So, how does that whole process work of getting them started?
It's a big lift. So I would say, first of all, the 40s Act world is a different world from the traditional just SMA world. It's a world of strict regulatory oversight. The SEC and FINRA are potentially in your butt all the time. Um, so it's a different regulatory world. I would say that from an operational perspective, a lot of this depends on if you're a big institution that has a lot of back office, if you've got your own legal, your own compliance, your billions and billions of dollars that could instantly transfer into the ETFs, that makes things a lot easier. You've got
But
to have
you don't
assets.
have that. How many, like, do you even have, how many people do you have on staff at your firm?
That's why we had to white label, because my whole business is so disaggregated now that, we've got compliance outsourced, and the ETF architect team manages a lot of our compliance and basically all of our legal. And so my entity, especially because it's so internet based, like, I'm hugely disaggregated that way. So it's kind of strange in that sense. But if you're the trouble with ETFs is you need assets to make them work. And when you launch an ETF, you have zero assets. You can't even really talk about the ETF, especially from a marketing perspective. They make it very, very difficult to talk about it because everything's got to go through like a FINRA approval process. But from a
Right, the hope
scaling
is that you're
perspective,
coming with assets already in a strategy. I think that's what most people think, is that, okay, so I can do the 351 exchange in, right? So you can move these assets in without taking a tax. And to you, it sounds like you're putting them in the same sort of strategy anyway. So it wasn't that big of a deal. But you can, if you want to, move these assets in and not have any sort of taxable event triggered while you convert it into an ETF, right? So that process, even I'm sure that's a lot of the heavy lifting, is you have to get all the clients to sign off, right?
yep.
Say it's
Yeah,
okay.
so
We're transferring into an ETF.
that's the other thing. You do have the appearance of a conflict now because you've got your own product, and like I would argue, like, with our business, like, I'm not really doing anything different than I was doing before. I'm actually just doing it much more efficiently, and the clients are getting a much more tax efficient output. But there's the appearance of a conflict of interest. Like,
Yeah,
I had
it is
an
funny. I've heard that
advisor.
too. But like, you're also thinking, like, as a fiduciary, I'm making this better for the client because I'm taking away some taxable events. So it's. I guess that's just the way it works in finance. But the other thing is, I guess for you operationally, since you outsource a lot of it, it's you take trading off of your hands, right? Now the client buys one ETF instead of buying 8 ETFs. And then you're not having to rebalance it personally. The team that you're outsourcing to, the ETF provider, they outsource it, right? Or they
It
do the
has
trading, I mean.
Yeah, I shoot off a spreadsheet, and the ETF architect team actually does all the work in the background. And so from a trading perspective, I don't have to manage the portfolio. I mean, our algorithms that I've written, they do technically manage them in the sense that they're providing me the output, but that's a couple clicks on the computer for me. But operationally, white labeling can be hugely beneficial because the back office management of all this stuff is incredibly intense. The legal, the startup process. From a cost perspective, I'll give people perspective that, like, startup costs are probably like $60,000. This is per ETF. It's probably like
Okay.
60,000 per ETF. You're probably looking at like $200,000 to $300,000 annually to manage a single ETF. That's just the cost of
And
the underlying
you kind
fund
of build that into your
operations.
investment expense, I assume.
Yeah, you have to build that into the expense of the fund itself. So these things are,
So
and
obviously,
they're
sorry to interrupt, but on an expense ratio basis, obviously, the bigger the ETF gets, you can scale it some,
right.
right?
Yeah.
So
So
the basis point fee, if you continue to grow the assets through either new clients or because the performance is good or the market's going up, hopefully on an overall basis and a basis point basis, the fee's going down.
yeah, and you've got two different things here too. Where, as an advisor with money, how much are you just cannibalizing or moving money into, this new sort of more expensive business model? Or, do you have the ability also to use those instruments to scale outside assets? And so for me, like, starting an ETF, and especially having, an ETF suite, is, in my view, it's going to allow me to scale much, much more efficiently in the long run. And I think that's part of it too, is that when you start ETFs, I think you have to think of them as it's a long game. These are not things that, like, if you look at Wes's business or Meb Faber's business, these were small boutique sort of ETF shops 10 years ago that they had 50, 100, $200 million for 5, 7 years. And then all of a sudden, like, something good happens. Meb had shareholder yield ETF go crazy. Wes has, brilliantly sort of built everything around the 351 exchanges. And then the box ETF, overnight, it's like a 10-year overnight success story with a lot of these businesses. But I think of my own ETF business very much as this is a venture capital type of business. It's almost like I'm running two different businesses where the ETF business is more of a startup. And it's a concept that, this sort of bucketing style strategy, especially, I know there's a huge adoption curve. People have to learn how this works. Bucketing strategies aren't readily available through ETFs. And so there's going to be a huge adoption curve. And so I think you have to think long term when you're doing something like this. And so the upfront cost is very daunting. And at times, like we had a crazy story where we had a 10% inflation adjustment inside of, because we had started our first ETF right after COVID, and we had this 10% inflation adjustment. And because inflation went up 10% at one point, and that just happened to be the year end. And so all of our contracts readjusted to this 10-year rate. And I was like, there was a point there after that happened where I was like, well, this business is not going to last much more than 3 or 4 more months. And so luckily that didn't persist. But anyways, so there's, like with any startup, there's going to be growing pains, but it is a very labor intensive. It's a very regulatorily burdensome business up front, especially. But once you kind of get things greased and going, I think that you start to see that, okay, I can see where this is going in the long run and why it's beneficial, not just for the business, but mainly are you solving a real problem for your clients? And that's the cool thing, is that I'm now, like, what I'm going to be able to do is, like, I'm onboarding clients now, and I'm going to be able to basically input portfolios where we're running an asset liability matcher through my software here, and it's outputting, let's say, a T-bill ladder with a tips ladder with 3 ETFs and maybe a growthy bucket, maybe something much more aggressive than our 3 ETFs. And you built a portfolio that when you present it to the client, they just get every component of it. And they understand, why do we own this 5-year fund? Why do we own this 10-year fund? Why do I own the tips ladder? Why do I own the T-bill ladder? Why do I own this text, component of the portfolio in the growthy component that is moving 1.5% every single day? They understand why their assets are actually playing a role relative to their financial life.
Right. And now, and like you said, so you can mix and match. Now you're going to have multiple ETFs. You can put them together for need be. So you can have more bespoke client portfolios, I guess. And the other thing, I suppose, is that some of these people might not even be your clients. They can buy your ETFs without even touching base with you, right? It's out there.
Yeah. Theoretically, like, a boglehead could go in and build their own 3-fund type of portfolio using our 3 ETFs. Just, and we're going to be publishing the basic version of our software online here in the next month or so. And so, yeah, my hope is that I think that it's very strange to me that I think as an industry, we do a very bad job of explaining time horizons, especially in the equity market. Like we talk about things like stocks for the long run, but we never really say, what does that mean? Is the long run 12 months? Is the long run, a couple weeks? Is the long run 5 years? Is it 20
you as the
years?
advisor might have a different definition of that than the client.
Yeah. And I think that it's our job, though, to correctly frame this stuff so that we're saying, hey, this part of your portfolio right here, your Roth IRA is invested 100% in equities, because equities are 20-year instruments and you're 30 years out from retirement. We know that when we approach that glide path period of maybe having to draw down the Roth at some point, we will have spent 20 years just growing this thing in an aggressive allocation, because that matches the liability need in the future. And when you explain it like that, like I went through this whole like funny process where like I got very obsessive about tax location at one point, and I would actually put like a lot of bonds in people's IRAs. And then I kind of woke up one morning and I was like, wait, this is totally wrong from an ALM, an asset liability matching perspective. The long-term accounts should be ultra aggressive. They shouldn't have any bonds in them. And so it's part of why I'm somewhat critical of even things like target date funds, because I would argue that like a lot of target date funds, if you're buying a 2060 target date fund, that thing should have 0 bonds in it, in my view. So it should, if its glide path is gliding, it should actually be a really herky jerky thing. Whereas you get to retirement, maybe you start buying big slugs of bonds or bigger slugs, kind of a, almost like a Kitsis bond tent type of idea. But
This is another topic, but I'm surprised we haven't seen target date funds that have leverage involved or something at the beginning for people who are just that's a different anyway. But the thing is that I want to get back to with the advisors is you've proven that you can do this as kind of a solopreneur, right? You have a very small footprint. You don't have a huge shop. There's other advisors watching who probably do have some operational staff. They probably have a decent amount of money in a strategy like this. So if you have some operational help, it can be even easier. But you've proven with, hey, I'm a small shop, right? I've been doing this myself essentially. You can outsource a lot of it. And even though I'm sure for you, it was a lot of hard work at the beginning and heavy lifting, now that you've done it, it's much easier. And I'm sure that your business is easier to run because you've made this change.
Yeah, 100%. I mean, and it is, again, I view it very much as like a venture capital arm of like my business. I mean, our SMA business it's not small, it's not humongous, but we're an SEC firm. And so you have to have the profitable business, I think, in order to start this and take the sort of big swing with an ETF. Because the upfront, the first 3-year process of this for an advisor, I think it's hard. And especially if you have dreams of raising outside money, you run into a huge number of hurdles where, first of all, the asset management space is just unbelievably competitive because you're playing with like the biggest, smartest, dogs in the pen right off the bat. And also it's just, there's a lot of 0 to 3, 0 to 5 year burdens where like a lot of investment firms, they won't even consider an ETF that doesn't have $100 million or a 3-year track record. And so you need the assets to make the thing work up front, and you can't get the assets because there's all these constraints. And so it helps to have partners. It helps to have the ability to scale. It helps to have a huge network of either other advisors or investors or existing money that you can help at least improve the probability that the ETF will succeed initially and not just cannibalize your whole business in the first 3 years before you can even get it off the ground.
Right. Yeah. Starting from ground floor level 0 would be very difficult, and you'd have to have a really long runway. But most advisors already have a book of business, and if they're thinking about doing this, they have an SMA or they have some strategy they want to use for an ETF. That makes it a little less risky. There's still risk involved, but it's at least you're starting with something.
If you've got just a cute idea that you think is this amazing stock picking strategy, and you think the whole world is going to adopt it over the course of the next few years because it's genius, that is not the right way to start an ETF. The right way to start an ETF, in my view, is solve a real problem for your clients. Do the 351s are incredibly valuable. These things are still so new. Meb and Wes are doing a ton of them these days, but these things are hugely valuable for especially people that have concentrated stock positions. I mean,
which is a lot of clients right now.
Huge number, especially everybody that owns Nvidia and Apple and all these tech stocks that have become so concentrated. These 351s are hugely valuable for things like that. And so, a lot of it is communicating the value add of what the ETF, because even for most retail investors, they don't really understand what an ETF even is. Like when I say the letters ETF, a lot of people are still like, wait, what is an ETF? Like I was back home for my parents' 50th anniversary a few weeks ago, and I was talking to my brothers and sisters about this, and these are all smart people, seemingly smart people at least. And I'm talking about ETFs, and they're like, "What is an ETF again?" And I'm like, "I started an ETF a few years ago, you knucklehead. Like, what do you mean? What is an ETF?"
I do think sometimes us in finance take for granted that we pay attention to this stuff all the time, and other people might not know that there is a difference, and there is especially even between a mutual fund and an ETF, right? Or where you have the money, and so you're right there. I think,
and that's a big part of this is that I'm constantly catching myself, even when I say little words. Like sometimes I say the equity market, and people will be like, "You mean the stock market, right?" It's like little things like that. We have to, as an industry, I think, not only communicate time horizons better, but also just use the same language. And I think that's part of the thing that I'm sort of obsessively, latching onto with time, is that time is this language that everybody understands. I don't care what society you're in or, what your background is, you understand time. And when you can speak time horizons to people, it just is so relatable. And also from an advisor perspective, for me, like using the time horizon based aspect, it's very intentionally personal. You have to get into very personal conversations when you talk about time, because you have to talk about things like you're going to die. Your kids are going to go through this life event at this point. And you get into these very personal conversations that before I was doing any of this sort of asset liability matching perspective, I would kind of tangentially maybe have those conversations, but not in such a strict sense where you're saying like, hey, you're going to die at the age of 85, and we need to prepare your portfolio so that the assets and liabilities are matched to that time horizon, that event.
Right. Okay. So if anyone wants to learn more about your business and your new ETFs, where do we send them?
Disciplinefunds.com is the ETF site, and ria.disciplinefunds.com now, where the discipline alerts page is. That's where I kind of do the more sort of bloggy.
Because you sunset Pragmatic Capitalism essentially, right? It's still there, but you stopped posting there as much, and now you're posting on the new site.
Yeah, everything's consolidated kind of into the disciplinefunds.com website. That just was kind of an operational aspect where I was, managing multiple different websites, where it got to a point where I was like, what am I doing here? I made my life so difficult. So starting to kind of, streamline the bucket here in a lot of ways.
That's the goal here. All right. So thanks for sharing your story, man. If anyone wants to hear our newsletter, talkingwealthpod.com, subscribe to the YouTube channel, and we'll see you next time.